Why hold the Wellesley income fund in a taxable account? That's a good question. Someone actually asked that on a comment on my video I did yesterday that John has too much cash, and I suggested he put $200,000 of his bank account in a taxable Wellesley income fund. Good question. So let's go into this real quick. So basically the issue here is we have John, who's a single guy. He's 60 years old or something like that, and he has $400,000 in bank accounts. We call that non-qualified accounts. Now, non-qualified accounts can be a taxable brokerage account, it could be a mutual fund account, it could be a bank account. The issue is it's taxed when you receive income from it. All right. So now what happens is John needs about roughly $75,000 a year to live on. That's all inclusive. So we need $75,000 as expenses. All right. Let me just close this. All right. So I'm sitting there thinking, well, 75 times 3 is what, 225? Yeah, 225. So I'm thinking he'll have 3 years of cash. It'll take $225,000, 3 years of cash. So I said, let's take 225 and put it into cash, just as a good old-fashioned bank account, and maybe a credit union, but I'm going to share with you an article later on about credit unions and how they sold their soul to BLM. It just infuriates me. I'm telling you, these guys, these corporate guys are going to rue the day they aligned with BLM, because that is a Marxist organization who hates America. And I do not know why big companies do this. It's just as nuts, but we'll get in that later. And then we're going to take 175 and we're going to put that into Wellesley income fund. All right. So we're going to say cash is yielding, just for simplicity, we'll say, I don't know, 1%, just for simplicity. All right. It's not, just bear with me just a second. We're going to say Wellesley. Now, Wellesley income fund has a 2% yield, and then last year had roughly a 1.4% LTCG. All right, long-term capital gain dividend, long-term capital gain, realized long-term capital gain. So I take my trusty calculator, and we can get a quick gauge of how much income this will generate. And we don't know if it'll be a 1.4% long-term capital gain or not. We don't know, but we're going to use what it was. This was actually just a few months ago in July, as a matter of fact. And you got to watch. It's not just a dividend yield on a mutual fund. You got to look at the distributions for capital gains as well. All right, you got to look at that to get a gauge of what your taxable income is. All right, so we take $175,000, we times by 2%, and we're going to get $3,500 of dividend yield, and that's going to be QDI. Qualified dividend income is what? Tax at 15%. Hold that thought. And then we're going to have 1.4% of long-term capital gain. That's $2,450 of LTCG. All right, LTCG. All right. Now we got, this is just straight income here, straight interest, and that's going to be $2,250 interest. All right, so we got, so what we can do here, let's erase over here real quick. And what we can do then, what we can do is I'm going to show you how the taxes work. I'll tell you what, let's erase everything but these things right here. There we go. Yeah, all right, sweet. So I'm going to show you how this is going to work from a tax perspective, and I think you'll be pleasantly surprised that what this will be for taxes. All right, so remember, my man John needs $75,000 a year of income. All right. So he's going to take it from the bank, but because it's already been pre-taxed, there's no taxes at all. There's none. So the $75,000 he pulls from his bank account is completely tax-free. He's already paid tax on it. The only taxable income he has is $2,250 interest. Then he's got $3,500 of QDI and $2,450 of LTCG. TCG. All right. Now, I don't even have to go hardly any further at all to already see this is still going to be not an issue. I mean, we can even go down this more if we want to. But we can already see immediately, I hope you can too, that this just won't be, this is a big fat nothing burger from a tax perspective without even diving deeper into this. So we take 22, just get my trusty calculator. So I don't screwed up. All right, so we got 2250 plus 3500 plus 2450. He's got $8,200 of income off these accounts. Now, without literally going any further, I already know that because he's under 65, he has a standard deduction of $13,300. That's so his AGI, adjusted gross income, is all your income added together. 2250, 3500, 2450. AGI is 8200. Standard deduction is 13,000. So he's got zero taxable income. And even that, we can even go even further. Is that we can say, look, man, you got 8,200 of. So we got these right here, because he's in the 10 and 12% tax bracket, even tax at zero. So in this case, he could probably start doing some Roth conversions. I always get a little bit nervous on Roth conversions, but let's just, maybe we'll save that for another video. We'll stop that one here at 6 minutes. And we'll say, okay, what happens if he does Roth conversions on top of that? So to have Wellesley in a taxable income account, Wellesley income in a taxable account, it doesn't do anything for his taxes because it has literally no effect on his taxes because $8,200 of AGI, again, of which these two things right here are taxed at zero as long as he stays in the 0, 10, or 12% tax bracket. 13,000 standard deductions, taxable income is zero. There's no taxes due, none. So for him to have in the Wellesley, the taxable income fund, it has no taxes due. Stay tuned. I'll do another now in the same exact scenario, but we'll add $25,000 of Roth conversions and see where that takes us. Thanks.